Hi, welcome to the second introduction to lease accounting. This video will talk about the view of accounting from the lessor's perspective, or the owner of the asset that is to be leased. As a quick review, a lease is basically renting an asset. You get an asset and fixed payments are made. In this video, we're going to take that perspective of the person that actually owns the asset, the lessor. The lessee is the one that actually receives it, uses it, and then returns it after the period. From the lessee's perspective, there was basically kind of two kind of leases, a capital lease or an operating lease in the perspectives that's talked about in the prior videos. The rules for a lessor are a little bit different. All right, so we're going to go through that. Under IFRS, there's basically two types of leases, what they call a financing lease or a capitalized lease or an operating lease. And you're like, well, what's different? Didn't we just talk about this? Well, yeah, but you have to realize what with a financing lease versus an operating lease, you got to remember for a financing lease and an operating lease for the lessor, it's the opposite of what it is for the lessee. So if you're the Hertz or the property owner of whatever's getting leased, if you have a financing lease, that means you lose the asset on your books. It needs to be pushed off of your books. And as a result, you have an account receivable that comes in. That's what a financing lease essentially does. An operating lease is the opposite. The operating lease, it's the opposite for what it would be for the lessee. The operating lease, you retain the asset and that stays on your books and you recognize the depreciation expense. Under a financing lease, the asset's not yours. It's basically off with someone else, and so you don't recognize the depreciation. You don't recognize these other things with it. That's one of the key differences under IFRS. Operating lease is pretty simple in the sense that you just keep it on the books and you depreciate it. Under a financing lease, you have to write the asset off the books because it's no longer your asset, and instead, what you're going to have on your balance sheet is the cash flows associated with the collections of that asset. What you're going to do is you're going to write off the asset, and then you're going to put on the books to replace that asset the value of this lease receivable. And the lease receivable will be all the cash flow payments plus whatever residual value it is anticipated to have at the end of the contract. So whatever the car or the building or whatever is going to be worth at the end of the contract, that's what's going to be written on your books. And you're going to represent revenue as those leased as those lease payments come in associated with your business. So that'll be part of what you recognize with that. And then you're also going to have some cost of goods sold related to the residual value. Under US GAAP, it's a little bit more nuanced. Under US GAAP, we have kind of three categories. We have the operating lease category, which is basically the asset stays on your books and everything's the same as IFRS. You know, it's a traditional lease in the sense that you keep the assets on your books, you depreciate the assets, and you basically set it up just the same. The sales type lease, the capitalized leases end up going into two different parts. One is called a sales type lease and the other called a direct financing lease. And the idea behind this is remember how leases can become a loan to buy an asset? Well, the question comes up philosophically, which one is the owner taking on? Are they taking on the role of a bank and getting a lot of their revenue as a result of providing financing to people that need it? Or are they actually, is this lease, just an alternative to sales? And really, is it a sales type lease? And so the question is that's what you have to identify under US GAAP. It's either a sales type lease or a direct financing lease. As a sales type lease, we kind of treat it like a sale of an asset, and it's more like the accounting of it's more like the purchase of an asset with financing from a seller. And a direct financing lease spreads out that profit over time a bit more. And instead of selling an asset, it's more like a bank loan transaction. So how do you know what type of lease it is? All right. Step one, is it a sales type lease? All right. Go through this step process. Have the benefits and risks of owning the asset been transferred, and does the lease meet any of the same criteria that the lessee uses? So the lessee uses a certain step criteria that we'll go through. And is the collection of the lease payments reasonably assured? All right. If yes, then it's a sales type lease. So the lessee has a certain number of steps that, just if you have any one of these things, it becomes a lease that has to go on the books. So the lessee has, it's 5 items. Transfer of ownership of the asset to the lessee. In the lease, if it stipulates that, then it's going to be a capitalized lease for the lessee. If it includes a bargain purchase option, meaning, you pay $1 at the end, you get the asset. If it covers a period of time, that's the major part, useful life. if it involves a lease payment that equal or exceed the asset's fair value. So all those payments are worth more than the actual asset. And the asset is specialized and will have no alternative use after the lease ends, meaning you're giving them this asset. It's specifically for them. If you get it back, you're going to have nobody to provide value to by having this. So if it meets any of those requirements, then you are going to call it a sales type lease. All right. So if it meets any of those same criteria, we call it a sales type lease. For the lessee, if you have any of those criteria, it gets capitalized. It's a capitalized lease. Step 2. All right, if none, so if it doesn't meet any of those requirements, then the risk of ownership transfer criteria, or if none of the risk of ownership criteria are met, or if the collection of lease payments is not reasonably assured, which a lot of times that happens, right? Somebody will make a lease and, there still could be uncertainty about it. So even if you don't have that requirements or the leases payments are not reasonably assured to be collected, they view this as the lessor can effectively owns the asset. Yeah, they might have transferred a lot, but these promises might seem shallow because they can't, you don't know if the person's going to be in business still. They might file Chapter 11, or they just don't meet any of those requirements. And so that will stay on the books of the lessor. And so if the lease basically effectively converts the lessor's risk arising from ownership of the underlying asset as kind of like a credit risk, they're becoming kind of like a bank. And so if you don't meet any of these risk transfer things, but you don't think you're going to get payment, and there's these other things, basically you're offering credit. And that's kind of a big part of what you're selling. And so as a result, we're going to call that a direct financing lease. You're acting like a bank, so that's what we're going to do. Even if the value of the asset, this is important, and this is a nuanced item here. Even if the asset is guaranteed by a third party, it's still going to be a direct financing lease, because the person entering into it is entering into it because of the financing that you're selling. Even if it's guaranteed by a third party, you would still call it a direct financing lease. So it's a direct financing lease in the nature of the individual leasing the asset or the group releasing the asset. There's some concern about whether or not they're going to pay us back. If no to both those things, then it's operating lease. So key difference for non-operating leases, i.e. capital leases. The IFRS has no distinction between the sales type leases and the direct financing leases. Under IFRS, firms meeting both criteria are treated the same way as a sales type lease. They're basically kept on the books, and they're treated just like that. The nuance between if you're selling the asset or acting like a bank is not there. The key difference being from the lease term. In IFRS reporting, the lessor will recognize the selling profit at the beginning of all the leases that are not classified as operating leases. So under IFRS, you're going to recognize all the profit on that lease upfront. Under US GAAP reporting, the lessor will recognize the selling profit only on sales type leases at the beginning of the lease term. All right, so IFRS and US GAAP line up on sales type leases, and then all capital leases under IFRS. US GAAP is a little bit different for those direct financing leases. And so this is a summary table to go through what actually happens for the balance sheet, income statement, and the statement of cash flows. So under IFRS and US GAAP operating leases at the top here, they retain assets on the balance sheet. They report the lease income and report depreciation expense on leased assets. So this is for operating leases. You're keeping the asset on because you're the lessor, right? That's what it says up at the top left-hand corner there. And so you're going to keep the assets on. You're just going to report leased income and depreciation expense on the leased assets for your income statement. And then statement of cash flows, lease payments received are going to be an operating cash flow. This is part of your normal operations. Under IFRS, under financing leases, US GAAP sales type leases, right? There's a line up there, and they do the same things for that one. Remove the asset off from the balance sheet, take it off the balance sheet because it's supposed to be recorded on the other firm's balance sheet. You recognize the leased asset as the receivables plus the residual. So how much you're receiving plus the residual amount or the value at the end of the period that you would get. On the income statement, you report interest revenue on leased receivable. And if applicable, you would report revenue or cost of goods sold associated and selling profit associated with this lease. Interest portion of the lease payment received as either an operating or investing cash flow under IFRS and an operating cash flow under US GAAP. US GAAP for interest basically is always going to be an operating cash flow. IFRS, they give you two options. US GAAP direct financing leases. All right, so this is the one that's very unique to US. So this is when they have this subcategory where they say in the United States, you know what, you're acting like a bank. So under US GAAP direct financing leases, on the balance sheet, you remove the lease asset just like you do on the IFRS financing leases and US GAAP sales type leases. You're going to remove the asset from the balance sheet. You're going to recognize the lease receivable. The lease receivable is going to be calculated in the same way, the amount that you're actually going to receive for the over the lease payments. The report of interest revenue is going to be on the lease receivable. So that you're not going to have all of your profit recognized up front. You're going to recognize the profit associated with this because you're more so than giving them an asset, you're being a bank for them. So interest revenue on lease receivable is what's recognized on the income statement over time. So you don't do everything up front like you do on a sales type lease. And the interest portion of the lease received is an operating cash flow under US GAAP. The lease principal is an investing cash inflow. So as you get cash back, you are getting cash associated with an asset that you bought for the business. And so the principal amount of that is going to be part of investing activities, but the interest that you get on that being leased out is going to be operating cash flow. So that's the summary table for the lessor.